Hello and welcome back to On the Money, our show looking at how to make the most out of your savings and your investments. I'm Dave Baxter. I'm the Senior Fund Content Specialist here at II, and I'm delighted to be in the hosting chair for the first time. We're going to tackle a pretty big topic today, that is market bubbles. Are we in a bubble or more than one? What kind of indicators might tell us whether we're in that? And most importantly for me, as an investor, what can you actually do if we're in a bubble? We have a really great guest with us today. That's Michael Browne, investment strategist at Franklin Templeton. Michael has been in the investment space for several decades. He's seen many a market boom, many a market bust, many a market cycle, and should be able, hopefully, to share some really great insights on this, quite meaty topic.
Been through a few, Dave. Thank you very much indeed. Yeah, no, thanks. I think it's a great topic, and I think it's really interesting because, as you say, if you hang around the markets long enough, you'll do 2 or 3 of these.
Yeah. So let's obviously there's lots of nuance that we will get into, but let's kick off with the big question. Do you think when we come to AI, when we come to stock markets in general, that we're in a bubble at the minute, and what is your rationale either way?
So I don't think we're in a bubble at the minute. It could develop. It's not impossible for it to develop. And I think this is where we have to kind of have a thought process as to what is a bubble and what isn't a bubble.
Yeah.
And what's the thing that's a notch below a bubble? Because we have lots of those. And that's a boom. So if you think about it, we go from enthusiasm to boom to bubble, then you can start to think of what is that differentiating factors between boom and bubble. Lots and lots of booms happen. One of my favourite ones, which went completely unnoticed, is the oil and gas capex boom of 2010 to 2014, which, by the way, dwarfs anything that's going on in AI at that moment in time. We're talking $1 trillion a year, $1.5 trillion a year over a 4-year period. So, but we didn't notice that because that was a boom in that particular industry. You can go out and find those. So that's a really good example when a boom doesn't become a bubble. A bubble is when you've got to have that all-encompassing, all-focusing exuberance, and the way, and maybe we'll get into this in a bit, I define a bubble, it's got to be money, mania and markets.
So obviously it's very difficult to, I suppose, tell when we're in a bubble, and there are perhaps different indicators. I was thinking before this, you might have quantitative things. So for example, I was reading up on, the AI bubble discussion beforehand, and people were citing the fact that if you look at things like price-earnings ratios on the Mag 7, it looks much less...
doesn't look too bad, does it?
Less challenging, than, for example, before the dot-com.
Absolutely. It's about half the rate at the present moment in time.
Yeah, but also, I suppose you have more qualitative kind of indicators. So this might be general sentiment. This might be the old adage about, getting into a cab and having the taxi driver recommend stock picks to you and that kind of thing, which admittedly is a bit patronizing towards taxi drivers. But well, what kind
especially as we're going to have robo-taxis.
Yes.
AI.
It's already a challenging time. But yeah, what kind of indicators do you look at when you're trying to, make a call on this?
Yeah, so let's look at what has to be in place for us to move. And again, let's hold that idea of moving from a bubble. You have to go from a boom to a bubble. Let's hold that concept in place. So first of all, you need obviously an ample supply of liquidity in the markets. And it's absolutely critical. So you'll be at a period where interest rates will be at a low or will be mulched around a fairly simple, if you like, and stagnated at a level for quite a long period of time. So there's that element of confidence in the lending markets, elements of confidence in the banking side, that you probably have got quite low default rates at that moment in time. So the liquidity conditions are good. I mean, they don't have to be wildly fantastic. They're just good, right? Then I think you have to look at this word mania. And this is what I say. So first of all, we've got that money piece. It's in there. We know we've got plenty of liquidity. I mean, there's some great examples in history. Actually, there's a great one from Germany in 1871, which led to the crash in 1873, which is they got 5 billion in gold from France as part of war reparations for the 1870 war. And that then went straight into the system as liquidity. So a great example of a bubble being created by external cash coming into an economy. So you need that cash, right? That's the first thing. Then you need mania, right? Now, what is mania, right? You need that sense of elevated, extreme changes in mood where people are rushing around, getting very excited about things. And if it drops 6% on a day, they get very disappointed by that. So you have that really big swings in mood. And as you write, it starts to catch a wider attention, starts to catch the attention of the wider population.
So do you not think we've kind of reached that point with stocks like Nvidia? I mean, Nvidia already has like huge expectations every time a trading update rolls around, and you can have quite big moves. Even if they actually satisfy or exceed expectations, you can have big drops and so on.
Well, that's where I would take that definition a little bit further. Okay, so I think, yes, people know about it. We have to be careful in our industry, if you like. Is it talked about on the Clapham omnibus, if I can use a different transportation expression about normal people, as opposed to what we're doing, which is talking about something because it's part of our daily lives, it's become dominant in indexes, etc., etc., etc. So what I would look for is a sense almost of high energy and social bonding, where you become part of a club. You become part of you feel you're part of that exclusive club where you're onto something and other people are not onto something. That's part of that mania, that over-enthusiastic, almost as if you're a football supporter and you travel anywhere to see your club play. That's the kind of excitement that I'm looking for to see in people and see in investors. And that starts to attract a much broader base of investors than the normal ones. And that's why I think it's really interesting. I think we have to be clever today about it. If you have a look at Andrew Sorkin put out his book on the Wall Street crash just before Christmas, really, really good book, because he's got lots of social detail in there. And you put it with Galbraith's great tome, then you have the whole thing put together. But it's that element of, we're still on the street corners and we watch the ticker tapes and we watch the prices coming out. Oh, I'm part of the club. I'm standing on the street corner and I'm doing it. That's the kind of atmosphere that I'd want to get. And I think where we see that today is obviously on social media. And when you can find those sort of clubs coming through and that sort of I'm part of the gang and I'm part of the team sort of sense on social media, that's where to look at it in terms of where we are. Now, are we there at this point in time? No, I don't think we are. I think we are in other assets, but I don't think we are in stocks.
So what other assets do you think we've kind of hit that point with?
Well, we have the great unregulated asset of crypto. And I really think we've seen some of the elements there. There are other elements in there, by the way, which really resonate from my point of view, going back over history in that area. Because a part of how we recognise that the bubble is bursting is to think about fraud. There will always be frauds in these things. I mean, there's always been frauds all the way through these elements, and I've kind of brought it in a bit early. But, there's quite a lot of fraud in those particular areas because it's a completely unregulated market. So how do we avoid frauds? You can't in these circumstances. There will be people who will do that. And spotting that and understanding that first failure and that first fraud is a key point in terms of finding somebody who has taken advantage through inappropriate means of that mania that you're experiencing.
Yeah. So let's turn to another asset. Obviously, sometimes people are now kind of comparing crypto with it, which is perhaps a different conversation entirely. But, last year, actually the last 2 years, we've seen the gold price surge enormously. And unfortunately, we've had more kind of geopolitical strife and very kind of worrying developments so far in 2026. Once again, we've seen kind of record highs being breached with gold, with silver and so on. Where do you stand on the kind of conversation that's been ongoing about gold being in a bubble?
Gold is a really interesting asset. First of all, it's been around forever. And it's been a valuable asset forever. And this has got, 5, 6, 7,000 years of history in terms of being worth something and people regard it as valuable. So you're dealing with something that is always part of your psyche, your monetary psyche. So does it have value? Yes, gold does have value. That makes it different. It has the longevity to prove that it has value. But that doesn't mean to say that you can't have a bubble in an asset such as gold. And the way I would look at gold is inflation adjusted. So for years, from the mid-1980s, where again the gold price was really propelled by trouble in the Middle East and wars, etc. From the mid to late 1980s to really 4 or 5 years ago, the gold price was falling in real terms over that period of time, even though the price was still accumulating. And then you have this extraordinary spike upwards over the last couple of years. So something must have changed in the demand patterns for gold, and it can't just. And then for people have come along with leverage, and I'd love to know how much leverage there is in everybody's gold purchase at this point in time, how much the brokers are offering you to in terms of debt to buy gold. But that element there is probably, there was an element of catch up, undoubtedly, in terms of the real price of gold. Has it gone too far, too fast? Well, I think anybody with an iota of market history in their minds would say it probably has. Will it still retain a value at the end of this? Yes, it will. And that's why I think gold's a little bit more difficult. You know, we have that sense of our monetary systems used to be linked to gold. Silver, I think, is less so. Silver is a market that has, since it was demonetized 150 years ago, is an asset that is prone to speculation. And we've seen people over time trying to corner the silver markets on several different occasions.
Yeah. I suppose one kind of related point is, you know, we talk about gold doing very well. We talk about AI stocks doing very well, crypto and so on. If we look at this more widely, last year was quite interesting because it was, you know, pretty much an everything rally. You know, maybe you had things like Indian equities struggle, but most assets, most markets
There's
did
quite a high degree
really well.
of correlation across assets, yes.
Yeah, so even if we're not in a bubble, I mean, kind of what does that mean for investors, and, you know, do we need to kind of err on the side of caution there?
So let's put that in from an equity point of view. Let's put that into context, right? We had the biggest single year of mutual fund equity outflows in the United States since this millennium last year. So we have stock prices rising at the same time as US investors took an awful lot of money out, more than they'd ever taken before, and sat on it. So there's something else that's going on here again. And you know, in local terms, most indices weren't very far apart. But obviously in dollar terms, because of the weakness of the dollar against the euro and other currencies, clearly that differential became much greater. And of course, it's the first year, for eight or nine, I can't remember exactly how many years, where non-US equities outperformed US equities because of that dollar differential.
I think it was the first time in 25 years.
Exactly, it's a very long
US underperformed all other major indices, basically.
Yeah. So you know, we have that situation, and that's currency related rather than, if you like, local value related. But yes, you're right. It was a very broad-based, mid-teens-ish sort of rally across equity markets as a whole. And the reason for that, I think, is pretty straightforward, is that the conditions at the moment are quite benign. They're quite resilient. We can argue that are we at the start of a cycle rather than at the end of the cycle? I think that's a really interesting discussion because I think a number of factors that will play that particular way. And the AI story, we can clearly see it's now having a genuine effect on profitability. The final piece is that, you know, the amount of equities that we have is shrinking, not expanding at this point in time. We've had poor M&A markets poor IPO markets for several years now. We've had private equity obviously coming into the market and purchasing what they think is pretty cheap assets. They can't release it back in, but that's fine. So we actually have an equity diminution rather than expansion.
Yeah.
And what breaks to change that particular process? Maybe it will break this year with a number of IPOs, some very high-profile ones scheduled.
SpaceX and so on.
SpaceX, ChatGPT. I mean, you know, OpenAI. All of these are on the slate at this point in time. Whether they come or not will depend on market conditions and depend, of course, on the price that people can get relative to the valuations they've already paid. But yes, diminution of equity has been a feature. So the markets have been able to withstand quite a big outflow from the mutual fund world at the same time as rising, and at the same time, of course, their equities the negative process has been going. So actually, equities are getting scarcer.
Yeah, I guess it's interesting, you know, discussing whether we're in a boom, whether we're in a bubble. The kind of key thing is, as an investor, what do you do about it? So I'd like to tackle both of those issues. Perhaps it'd be interesting actually to start with a bubble, because when you think about market crashes, also when you think about some kind of big events, I think of, for example, the Brexit vote, Trump in 2016, you could have correctly forecast what would have happened, but markets then didn't exactly behave how you would expect them to. So if, say, someone disagrees with you and they think we are in a bubble, what should they do to start off?
Absolutely. So let's do the bubble piece and let's do events as separate, because I think they're two separate elements. The way to spot a bubble is, or a bubble closing out, I don't think that's more the question, isn't it, Dave? First of all, interest rates are rising. In every single instance of every bubble that I've looked at since 1720, South Sea bubble, rates have been rising. So rates started rising in 1928, not 1929. They were rising a long time before the market actually peaked. So the first thing is you start to see money taken away, right? The second thing is you will have one or two businesses associated with that particular mania at that moment in time, which will go bust. They are not auto park businesses. We're looking for something around the AI space that goes bust. And at that point, there's a really interesting comment that people will make. We'll go, oh, don't worry about that. It's just a bad business model. Really? But it's in your sector. No, it's just a bad business model. In other words, you can feel the tides beginning to turn at that moment in time. So people will see it, but they will ignore it. It's just as an aside, it's amusing Jamie Dimon made his cockroach comment last year. Alan Greenspan made the irrational exuberance comment in December 96. That was a full 3, or you could argue almost 4 years before the markets peaked out. So again, indicators like that I think are worth holding. But 1, rates are going up. 2, somebody goes bust in the sector. So somebody kind of dents the confidence a little bit, but everybody brushes over it. 3, as rates start to go up, that question of leverage in both positions and the businesses starts to have an impact. Businesses want more capital. They need some more capital to continue going forward because they will be debt laden. This is the traditional way. It's going to be different with AI because there's a lot of cash in this business. But the debt laden businesses will start coming to markets for injections of capital, and they will struggle to get some away. So there'll be another early indicator. Oh, that issue didn't get done so well. It's left a bit with the underwriters. Oh, but it's fine. I have the next trading results. You'll hear all of that. Then you will start to see the market unravel, and when the market starts to unravel and you get reverse velocity, it's when the leverage comes out. We saw this with Bitcoin on the 19th of October last year. Suddenly we realised a lot of people lent a lot of money against a lot of Bitcoin positions, and they were forced to liquidate. So forced liquidation then becomes your unravelling. Now we're in it then at that point in time. But there's one further indicator that I think you would always see here, and you'll probably see it before you get to that reverse velocity piece, and that's fraud. There will be fraud. There has always been fraud in every single one of these bubbles. So I think there's some really strong indicators. If you believe it's a bubble and you see those 4 factors come through, then you can say, yes, I should be out at this point in time, and I need to sit on my hands.
Is that the best approach then? I mean, to survive in a bubble bursting, or is it also, how far does diversification go? What have the kind of approaches been that have served investors well? There's
always diversification, but some of that diversification has to rely on the actions elsewhere. Remember, I'm talking about a period when rates are rising. So your diversification into longer term bonds is not going to be there. Okay, you might get some diversification from quality credit, corporate debt, so triple B and better, high quality credit at the short term, so in the 2-year level as well. You might get some in terms of cash, that would be the classic holding point. And obviously some of the gold buying that we've seen must be as part protection, and people are trying to diversify assets and struggling and really running out of diversified assets to hold. So there are areas that you can diversify, but I can't remember who said it, but the best way to understand a bubble is to be involved, as somebody once said. And that's why I would prefer to give people a checklist of elements to say, right, this checklist is now coming through. Here are the 3 or 4 points you need to look at. And if you see all of those come together, then yes, I would absolutely sit on your hands at this point in time. I'd go to very low risk assets at this point. Are we there? No, we're not.
So what kind of low risk assets?
Well, I think the key then is going to be depend on your liability structure, right? So you're going to have to say, if you're a UK investor, you're probably going to end up holding as much cash as you possibly can at that point in time within your banking regulatory limits, of course, which I think is £120,000, if I'm right, at this particular point in time. So you could move a lot of assets across several different banks and still be protected by the liability schemes. And I'm thinking, you can hear I'm beginning to think like 2008 again. And the risks that people didn't understand they were running in some of the bank's balance sheets at that particular point in time. But that's, if you had a real proper bubble, and as I say, I don't think we're anywhere near that at this point in time, but if you had a real proper, that's how you're going to have to think.
Yeah. I suppose then we are running into the classic kind of behavioural problem of, if you are sitting on cash, missing out on market movements, and when do you actually decide to reinvest and so on?
Yeah, so Again, we have for the individual investor, they have an astonishing range of tools today that they didn't have in 2008. There are, goodness knows how many short ETFs that you could go to at this point in time, and you probably should, because the best way, again, of spotting the bottom is actually to be involved in the markets. And one of the real things that we've seen about markets over the last few booms, crashes, events is how quickly they get to their lows. I mean, 17th of March was the low. 2020 was the low for markets in COVID. Right? It was 3 weeks after the Italians had shut the north of Italy down. It's very, very, very fast moving. Markets fall very quickly and rise slowly, and I think people need to remember that as well.
Yeah. So, any other kind of key lessons you want to share from your rich history of bubbles, booms, and so on? Any things that investors should bear in mind?
Well, I think if you hit money, mania, and markets, that's the key piece to go through. If you take those three headings and you think about them and you work with them, your ability to spot the bubble will be great. The question is, then you have to also play the game of boom or bubble. And I come back to the point that the oil boom of the early 2010s, by the way, just after we'd had a great financial crash, and apparently there was no money about, right? No, they were able to finance that absolutely fine. Think about the mobile telephony boom in the late 80s, which culminated really in price terms of Vodafone buying Mannesmann at that particular point in time. That was a boom, but it wasn't a bubble. Think about, maybe very close to home, the cable operators boom in the late 80s. When the regulator opened up the streets and you could put cables down the streets, etc., etc. And what did we have? 8, 9 companies at that point in time that raised capital to do that? We've got one company today because they were never able to make enough money from each individual position to be able to actually justify the capital that was in the ground at that point in time. Yeah. So I would say to investors, you really need to understand what the difference between a boom and a bubble is. Because your behaviour will be completely different. In a boom, that sector becomes off limits. You don't want to get involved in it, but there'll be plenty of other sectors that you do want to get involved in. And you may well have a completely different set of interest rates, a different interest rate backdrop at that point in time, which will not exist in the bubble moment.
Yeah. So stick to your triple M's or your 3 M's.
Yes.
Look for rates rising, look for things like fraud,
yes,
debts, that kind of thing.
Yes, and look for that early company in that sector that's gone bust that everybody goes, oh, it was just a bad business plan, right? Everybody brushes off. That's a great sign.
Yeah. Okay, very interesting. Thank you for your time. So, no bubble yet, but do keep an eye out on those metrics. Thank you for watching. Thank you for listening, and do catch up with us next Thursday. Take care.